Hi, everyone, and welcome to Behind the Numbers. My name is Dave Bookbinder, and welcome back. Thanks so much for joining us. If you're a business owner, you probably are operating in we'll call it, somewhat unsophisticated manner, certainly relative to what private equity expects when they jump into the picture. And oftentimes, it's a little bit of a shock and a surprise for folks when they get involved with PE. Today's guest is going to be able to share not only her journey from the experience in working with private equity, but also she's very active in helping companies become more sophisticated when private equity enters the picture. And I am pleased to welcome Claire Milligan, who is CEO and co-founder at Aimably. Claire, welcome to Behind the Numbers.
Thanks, Dave. I'm excited to be here.
It's great to have you. So I kind of teed you up a little bit, but before we jump into the PE journey, why don't you just introduce yourself to the audience?
Sure. I'm Claire. I am, as you said, CEO and co-founder of Aimably. I spend my days helping technology companies be more successful financially under private equity ownership. And before that, actually got my career started as a software designer. And sometimes you'll find me in the mountains. I'm also a volunteer ski patroller.
Very cool. And I know that you've got great domain expertise in the software space, and I know that's where you spend most of your time. But so much of what you share is transferable to businesses across a variety of industries. And that's what's really intriguing about your conversation today. So why don't we start? I teased it with your PE journey. You've got some experience, practical, hands-on. Why don't you tell us about that?
Sure. I got started in San Francisco and I was a software designer. And in that world, we were all very focused on venture capital. And in the world of venture capital, you're trying to show that you're growing and you're developing a product that people enjoy, and then more cash gets thrown at you, and it's delightful, and you celebrate and you buy stupid things, and then you keep going. And we were bought by private equity. A few years into my experience, I had already started helping the engineering team and being more of a product leader. And when private equity came around, we kind of thought it was the same thing, money, fund, throw it at us, we get to do fun things. And that was not the case. And so it was a bit of a trial by fire for us to figure out what exactly was going on and what was expected of us. So we merged and eventually with about 8 former competitors over the course of about 5 years. And during that process, it was a continual evaluation of who are our competitors, what does the industry look like, how can we better serve these folks, how can we offer more services to them. And slowly but surely, I was able to rise in those conversations and participate at a higher and higher level, because it felt like an opportunity each time. And luckily, the folks and the leaders in the firm saw that in me and that capacity that I had as well. So by the time I ended up leaving that company, I was the general manager of the line of business that I started in initially, and decided that there was a whole lot that I could do to help others. Specifically, I started focusing on cloud costs because in the technology world, that is a huge expense. It's the second largest expense to people. But really, the driver behind it is helping people understand what's expected of them, especially as executive leadership, helping them translate what the private equity partners, what the operating partners expect of them, and how to chart their path towards success.
Yeah, good stuff. And throughout my career, I've worked with not only private equity companies, but the portfolio companies for a lot of reasons. And a lot of times the portco leaders are literally shell shocked in terms of what they're asked to do. And it's all in the name of value creation and value enhancement. And, PE ultimately is looking to make an exit and make a profit on their investment, which is all good stuff. And business owners can certainly participate along the way. But let's talk a little bit about your experience and how you're helping companies in their value creation endeavors.
Yeah, I mean, the value creation word is something that sounds on its face to be logical. Uh, but for those who are not familiar with private equity, the concept here is you take a good company and you push it to greatness, as opposed to a company that could hit or could become the next big thing. It's a good company already, and we're going to take it and change and pull every single lever and tweak every single opportunity in order to make a more successful, financially speaking, company, so that when that private equity firm exits, it's going to be a great company, especially on paper. So the decision-making process is often not, what makes us special in our culture, but rather what makes us special in our revenue, or what makes us special about how we spend money, or is a very important question, because oftentimes the value creation is easier on the cost side. That means cutting costs. So
Sure.
what we focus on in this software world is those cloud costs, like I was talking about. They can become so difficult to control and understand. And when I say cloud costs, for anybody who's not in the software world, because I know we're not just talking about software, this is the cost of running software on AWS, Azure, and Google Cloud. And the way they function is they're kind of like metered systems, metered utilities, except for they have like 200 different ways you could collect cost as you run. And so there's all kinds of different ways that you can run up those costs just by metaphorically leaving the tap open somewhere or letting a toilet run.
So tell us a little bit about the kinds of companies that you're working with day to day.
So the companies that we're working with day to day are ones that are in the process of significant change. So we generally work with a private equity portfolio leader first, and then we'll start working with the companies in their firm. So they're going to be the folks that the operators, or I should say executives that we work with, are going to be ones who have been sitting in meetings quite a lot, receiving a lot of pressure towards what they need to do to change. And so then at some point we show up and we say, hello, how can we help? And start getting involved.
Yeah.
When you said they were shell shocked, it's absolutely true. That would be 9 times out of 10.
Yeah. A lot of times just the reporting requirements alone are overwhelming, going from working maybe in QuickBooks to now reporting on a monthly basis or even more frequently in
Yes, I
greater
remember
detail.
filling out a daily spreadsheet of KPIs.
Daily
That
spreadsheet.
was my trial by fire.
Okay, that's wonderful stuff. Claire, I've heard you talk about learning, our businesses needing to learn to run in what you call an assembly line model.
Mm-hmm.
What does that mean?
So in technology, we have businesses that write code, deploy code, and that turns into your software that you use primarily through the internet. And the employment model of this is a huge amount of experts, very highly qualified, advanced degrees, all addressing the small details to large development ideas that drive the ever-changing experience that you have. And I don't know about you, but that sounds a lot to me like a very old school fashion house in Paris in like the 1800s, right? You've got the couturiers, and they're making tailoring changes to the dress, or they're making a brand new one. And we have been eclipsed in the years since the 1800s with fast fashion, and even to the level of Shein, who can develop a brand new style and put it into the market locally within hours. We can't do that in software yet. And we can see this in different industries. There's different evolutions, but what I'm seeing in software right now is it's still it's apprentice model, it's expert led, and the financials behind it aren't very good. When we look at software companies on the public markets, we see a lot of cost and we see a lot of growth too. And so we believe, oh, because of all this growth, we can see a potential future. And what's also hiding in this is that the majority of that cost of those experts is below the net revenue line. When I'm going to take a detour into the finances for a really quick pass, but one of the most important things to a private equity firm is the income statement, which basically says, here's the revenue, here's the cost to service those contracts, and that subtracted from the revenue is what's called net revenue. All the other expenses are below that line, or they might even be capitalized, and they count less. So when you're saying, oh, this company has really low margins, we're talking about the ratio between that cost to service the contract and that actual revenue. All those software engineers, they're way below that line. But we require them to solve bugs, address customer problems. And if they're not working, those customers are going to be leaving, because we've seen lots of software companies start to devalue their employee base, and they start going. So my argument is not only are these companies very antiquated in their operating model, but they're ripe for disruption, especially with the arrival of AI and the ability to develop and produce code at a much more rapid pace. So my argument is we are going to see very soon an industrial revolution in the production of software.
Interesting. And yes, a couple things that you touched on there that I jotted some notes down on. Devaluing your employees. Anybody who's listened to this program and knows anything about me knows how I feel about that position, because I do believe that your people are your last bastion for value creation. So that's critical. But when you said you wanted to deep touch on the financials just a little bit, um, I thought that was an interesting detour, and I'd like to continue that, maybe go a little bit further down and talk about some of the metrics that companies really should be paying attention to. I mean, certainly everybody hears about EBITDA, right? What other things, and you can certainly speak to EBITDA, but what metrics should companies be focusing on to put their best foot forward?
It depends on your stage, right? So when you are getting started, it's all about growth. And as you are becoming a much more mature company, yes, it is about profit and EBITDA, but also you know what? Depreciation and amortization and taxes and interest, those are very important expenses. So I don't love the idea of taking those out with EBITDA. But in the world of private equity, we focus a lot on the ratio between your growth and your EBITDA. So one of the KPIs you'll hear a lot is the rule of 40, which is you should be able to take your yearly growth rate of revenue and add that number to the ratio between your revenue and your costs, which would be your EBITDA percentage. Together, those should create 40. So let's say you're growing year over year 30% and you have a 10% EBITDA margin, you've hit rule of 40. That is hard. It's very, very hard to get to that. And so that is seen as a gold standard of a truly excellent company under private equity ownership. Now, there's plenty of great arguments against that because it can be quite misleading. A 40% EBITDA company is very different than a 40% growth company. But remember, in the cases of many tech companies, especially once they hit the public markets, is sometimes their EBITDAs are negative. So that has to detract from that growth. And that's an important indicator. The other KPI that I pay a ton of attention to is the gross margin percentage, which is that percentage I was speaking about, which is the revenue relationship to the cost to service the contract. When we are talking about a great technology company, we're talking about one that has a gross margin percentage of about 80%. And in most other industries, that's incredibly difficult to do because you have to service the contract through a lot more labor than typically is seen in software. Finally, and also this is software, is the relationship between the cloud hosting cost and revenue, because these numbers go up as you increase users and utilization of your system. So an ideal pricing model should match that utilization cost. It doesn't have to be a one-to-one relationship, but that revenue should go up step by step alongside the cost of the cloud. And if it's not, then you really need to reevaluate that pricing.
Yeah, lots of good nuggets in there. Thank you for sharing that. Investors and buyers definitely are looking for both growth and profitability, and it's cool that you highlighted the distinction between the two. One of the things I didn't hear you talk about that I wanted to just ask you about is this notion about recurring revenue and how important that is.
Mm-hmm. Yeah, the idea of well, let me take a step back. Investors will push any software company to be what they call a SaaS company, which is another way of saying recurring revenue. Your revenue should be recurring. We're not selling licenses. We're not selling discs anymore. You're not selling a permanent access to something. Rather, you need to be paying us on a monthly or annual basis in order to continue to have access to our systems. Recurring revenue is an incredibly powerful thing to grow a business, because if you have a business that's not recurring revenue, every time you make money, you need to have sold to that customer. And with recurring revenue, you sell once and then they continue to come back as long as they're mildly happy. It also allows you to separate the functions out from sales and customer retention. So customer retention conversations can be a lot more sophisticated and can use a lot of technology to bolster that conversation. And so you end up being able to grow because you're constantly adding revenue to a pile you already have. Also, people don't really blink an eye when they say $100 a month, but that does add up to $1,200 a year and $2,400 every 2 years. And, it continues to compound in a way that buyers don't often see and are not good at comparing between flat rate.
Yeah, and just help us understand where the pendulum shifts between the growth and the recurring revenue, and ultimately the profitability. Because ultimately, you want dollars that are profitable.
Right. You want to be able to invest back into the software company. That's the thoughts, at least. That's the goal of profitability at this point in technology. However, I'd rather put it into investors' pockets and dividend and grow as a business owner. But, sorry, that was a side note. But my point being here is that recurring revenue allows you to continue to grow at a rate that is faster than if you had to acquire every piece of revenue through the efforts of a salesperson. So if you think about that, you've got these continuous contracts that do not require that active sale. That's a much lower cost. And so your profitability is revenue minus cost. And so when you have a lot less of that sales cost and maintenance cost in order to continue to sell to those customers, you're automatically in a more likely to be profitable scenario. And then again, as it continues to build on itself, the theory at least is that you can operate at the same cost level without and continue to grow that revenue on top of it.
Nice. So, Claire, you shared a couple of posts on social media recently that I found absolutely fascinating. You asked some questions of your network, and I want to throw them to you and let you share them with our audience here on Behind the Numbers, if that's okay with you.
Yeah, let's do it.
The first one, I thought this was just brilliant. I'm paraphrasing here, you're going to have to help me out with the actual quotation, but basically you said something that if private equity is asking you something for the second time, they're not asking. They're telling you something, and you better pay attention.
Yes. So there's a short time frame for private equity to create results. When private equity firms raise a fund, they promise a return to their investors. That means that they need to acquire companies, transform companies, and sell companies all within that time frame, and then return more money to the investors than they started with. So they are under pressure. When they acquire you, or when they merge you into somebody else, or when they start the conversation, they have built what's called a operating model, which has a corresponding 100-day plan that will get a company from a very different starting point to much more closely to their ideal state quickly. So you arrive at a meeting and they ask you a question. Tell me, it seems like you have a lot of marketing expense, for instance. Can you explain what's unique about your business and why? You go and explain. You give the reasons why your company is operated a certain way. But you've got to remember, private equity bought you because you're a good business and you have the potential to go to greatness with a lot of financial change. And so the question really is, tell me what landmines I might hit when I radically change your marketing department. That's the real question. And so then you respond. And then what you often think when you are new to private equity is, I gave my explanation. We are clearly great. You bought us because you like us. And so you believe me. And now we're going to move on. And I'm very confused when you come back and ask me the same question in a week. Well, the answer is, I'm just double checking to see if you came up with ideas on how to make it better. When the same question comes around for, tell me what's unique and different and why you operate your marketing the way you do, the goal of the person having the conversation representing the private equity firm is to discern if you are the leader that is now capable of taking that marketing department and making it match that 100-day plan. And so it is not in any way a question. It is rather a valuation moment of your capabilities. And it should be the time when you start saying, I need to change my focus. I need to understand the real ask behind the question. And I have an opportunity to change my leadership style, perhaps, or leverage my leadership style for more outcomes and decide what future I want to have with this business, because it is going to change and I have an opportunity to be a part of it or take myself out of it.
Yeah, or be taken out of it if you're not responsive.
Correct. If you continue to respond and say how excellent and wonderful you are and how you should never change, yeah, you're probably going to be looking for other work.
Yeah, short timer for sure. You alluded to the first 100 days, so I'm going to jump to another one of your recently asked questions that I thought was interesting. You said if you thought diligence was brutal, just wait for the first 100 days. So I'm going to ask you to explain the diligence process for folks who maybe haven't been through it, and then talk a little bit more about this 100-day process.
I liken the diligence process to buying real estate. If you've bought a house, you're going to say, well, I need to do an inspection of the ceiling, and I need to do an electrical, and I need to review the title, and I need to evaluate the floodplain. And if you're in California like I am, earthquake risk. There's a whole list of things you need to validate in order to be really sure that this is the house you want to close on. The same thing happens in diligence. It's just business wise. Are your financials straight? They're going to go line by line through a lot of weird transactions and actually ask you a lot of questions about them. Try to uncover whether or not there were mistakes that could affect them, that they could have legal liability for. They're going to ask you, they're going to want to examine your code. If you're a software company, are there areas of risk? Are there security holes that they need to worry about? It's going line by line by line to validate. On the surface, this looks like a great house. This looks like a great company. We like the revenue. We like the profitability. We like the people. But we're going to go and check line by line by line and make sure that we're not making mistakes here, and make sure that we are our funding model will make sense as well, because oftentimes they're going to take out a loan. It's like a mortgage, right? And they have to be able to pay it back on a regular basis based on the cash in the business. So they have to confirm that as well. But the difference between diligence and the first 100 days is that diligence is answering these questions of buy or no buy. And 100 days is how quickly can I turn this business into a different financial model? Turn up the revenue, turn down the cost, and aggressively expand opportunity in markets. And that's a real shock to the system sometimes.
Yeah, good insight there. I love the way you describe the process. I know that's adding a lot of value for the folks out there listening to this program. One more for the audience, if you don't mind, Claire. One another post that a question that you posed in a post. Actually, this wasn't a question; it was a statement. You said, "I'm protecting my team is the worst thing you can ever say to private equity." And
Yeah.
a lot of business owners are thinking about their people as hopefully their most important assets. They've come along for the journey. They've helped the business owner get to where they are today. A lot of them have the instinct that they do, in fact, want to protect their people from a number of different things. Why is that the worst thing you can say to private equity? And when
Well,
does
first
that
of all,
happen?
I agree. People are your best asset, and people love challenge. They have an opportunity to change, to grow, to reach new heights, and sometimes that can be a real wonderful opportunity. So there's two sides to this. I will speak to the private equity side, but from the side and the perspective of the employee, if you're getting protected and blocked and don't have a relationship with where the company's going next, that can be incredibly frustrating from the employee's perspective. But turning around to the private equity perspective, when when folks say I'm protecting my team, almost always what they're saying is, I had a strategy. I liked the strategy. The strategy was working for me. And I got confirmation that that strategy was working for me because you guys bought us. And so you coming in and messing around, you don't understand our business. You don't understand where we got here. You're asking questions that don't make sense. So I'm going to throw myself on top of those. I'm going to answer, deflect, find anything I can do so that my team can continue to do the things that they've always been doing that made us so successful. And when we think about it that way, you're basically blocking those 100-day changes, and you're blocking the value creation process because they didn't buy you to just operate you. They bought you to become a great company. So eventually the person who says I'm protecting my team, and no matter what they say to private equity, everything continues the same behind them, that person ends up being let go. And it can be devastating to your team because they've been operating under this halo. They don't understand what's going on. They see that you're now bought by these other people. They don't know, they don't understand, they don't know the strategy. And then all of a sudden you've left, and they're kind of at loose ends and not knowing what is going on. So that can be incredibly damaging to your business, especially if you still hold equity in it. And it can be really harmful to those employees that you think that you're helping.
Yeah, and you said something in there that I jotted down where the business owner may say or think that the buyer doesn't understand the business as well as they do because they grew up in it, it's their baby. But
Yeah.
the folks in the private equity space are some of the smartest people you'll ever meet. They've got domain expertise, operational expertise. Um, they know their stuff. What do you tell to the business owner who has the belief that the buyer doesn't know their business as well as they do?
Well, I agree to a certain extent, and that's why they bought the business and kept you in it. If they felt that there wasn't anything unique about it, they probably would have bought you as an add-on to another investment, and you would have been able to take your cash and go as the former owner. But if they've bought you, invested in you, and you are the leader of the go forward business, yes, there is something special and unique about it, and you hold that knowledge. However, the financial goals remain the financial goals. There's going to be more revenue in your business, it's going to grow faster, and there's going to be less cost. And so your job is to take that knowledge and that uniqueness and translate it towards those goals. And if you can't, then you're blocking things and you're not participating in the value creation process.
Yeah. Claire, we're getting close to the end here, but before we do wrap, I want you to maybe share some tips or lessons that you've learned along the way that our audience will benefit from, maybe even some actionable stuff they can use right away.
Yeah. There are these folks at private equity firms called operating partners. Most often, they are folks who have been around a lot. They've been running businesses like yours. They've seen the industry from a lot of different perspectives. They are phenomenal assets and they can explain to you what's coming from the financial side. So do use them. That being said, they are compensated by the results they're able to create with you. So if you think that they're the ones that are going to tell you, oh, you're doing a great job, pat on the back, continue along, that's probably not going to happen. So
Hmm.
keep your eye out for operating partners. They're fantastic resources, but they also have clear loyalty and goals associated with the firm's outcomes. There's also models that they will then borrow from. So there are a couple of different strategies. Pardon me, there's a book called Scaling Up by Vern Harnish who really describes that process of good to great, and so that can be a great resource of understanding the playbook of the various knobs that are going to be turned. He talks a lot about cash. It's like there's the people is one of the legs of the stool, and then cash is another, and it's very different from a naturally growing business, and so a lot of that is financial education. So that would be my third point, is really lean into financial education in terms of what are the financial statements, what are the KPIs that are actually being asked of me, and to research a little bit more about how that might apply to your business, because they might assume that you have a little bit more fluency in those terms than you do, and it's best to catch up to that expectation.
Yeah, great advice, especially that last one, because my experience certainly jibes with that as I work with business owners. They've created something wonderful, and a lot of times it's because they have a unique gift, a skill, a perspective, or a selling capability, but not necessarily the financial acumen that they need, and that's so critical to understand what the business metrics are.
Yeah, and honestly, if you created a business, you are uniquely capable to take it to the next level because you can make amazing things happen. You have to set the ego aside a little bit and say the business is going to change. I did sell to private equity, so that is the eventual goal. And I now need to adjust my strategies and learn a little bit more and use my skill set that got us here to take us to that next level. And you can be incredibly successful.
Yeah, really well said. And great insights here, Claire. Really appreciate you sharing. Tell the audience how they can learn more about you, how they can work with you, where they can find you.
Sure. As Dave mentioned, I'm pretty active on LinkedIn. So my name is Claire Milligan. It's Clairemilligan, and you can find me over there. I'm also pretty active on Medium, which you can find me by my name. My business is Aimably, Aimably, and we help CTOs thrive under private equity ownership. And you can find us at aimably.com.
That's awesome. Yeah, definitely check out her LinkedIn stuff and answer those thought-provoking questions that Claire poses. Claire, thank you so much for joining us today on Behind the Numbers.
Thanks, Dave.
It's my pleasure. And thank you out there for listening to this program. We truly appreciate all your support. If you enjoy what we're doing, would you be kind enough maybe to leave a review so other people can become aware of the program? It certainly helps us in a big way, and I appreciate you doing that. That's all we have for today, gang. We will see you next time on Behind the Numbers. Take care, everybody.